Welcome to the SouthBuy channel. Here we try and find stocks that don't get much attention, and we teach how these companies can be valued using standard valuation methods like discounted cash flows or PE ratios. We use unique screeners to find some gems and share our analysis with you. Orion engineered carbons known as OEC has survived the stormy seas of the last 3 years. They are forward-looking and are implementing strategies that will increase their capacity over the next year. With everything happening in the economy, such courage and optimism are hard to find. Like so many stocks that we cover, OEC's share price went from $21 to $13 in September. At the end of 2021, OEC revenues increased by 24%, but profits fell due to supply chain issues and an increase in oil prices. Many of these risks have been alleviated in 2022, and the OEC leadership seems to be positioning themselves for success. Let's jump into the bull case for OEC. OEC, according to Barron's.com, engages in the production and supply of carbon black. It operates through the following segments: specialty carbon black and rubber carbon black. The specialty carbon black segment manufactures specialty carbon black at multiple sites for a broad range of specialized applications. The rubber carbon black segment is used in the reinforcement of rubber in tires and mechanical rubber goods. Specialties are used as pigments and performance additives in coatings, polymers, printing, and special applications. OEC splits its business into two parts: rubber carbon black and specialties. If you looked at OEC financials, corporates are overhead costs that can't be allocated to a specific business segment. Their financial performance has been amazing. Even during these challenging times, OEC has produced a 25% increase in net sales. Increases are not due to volume, but favorable product mix and price increases passed on to customers. According to the press release, the increases have been incorporated into its recent contract negotiations. These results could have been better if it weren't for such a strong dollar. The rubber carbon black business has done exceptionally well, with most of the growth in volume coming from the EMEA region. The increase in net sales was due to volumes. A larger contributor was the fact that it could pass on the price increases of the materials used to produce its products. Unfortunately for this business segment, the increase in net sales has not resulted in a larger EBITDA. Increases in its overhead costs outpaced the increase in net sales. Inflation and a strong dollar are large contributors to this. OEC has been a consistent revenue generator for many years. Even though revenue dropped during COVID lockdowns, the team has done well to maintain profitability. The real issue for them is how they convert its increase in revenue into profits and cash flows. High oil prices and currency translations are what is resulting in no increase in profits, even though you can see double-digit growth in net sales. OEC has the capability to transfer the increase in labor and oil to its customers. OEC is also engaging with multi-year deals and setting pricing that will ensure consistent revenue and profit for the future. This is great news, especially as they need to create consistency while investing heavily into its capacity. What is encouraging is that in the earnings call in August, the CEO and CFO were optimistic. Demand for their products is still outstripping OEC capacity. Due to this, they are investing in increasing capacity at their various plants to deliver on this demand. Part of this capacity increase strategy is a big bet on the EV megatrend. With their new value creation mindset, they are targeting $500 million in EBITDA by 2025. This target, in my opinion, is achievable. OEC is investing in its capacity to expand profits and revenues, not to purely maintain the status quo. The current PE ratio of OEC is 9.8 compared to a peer average of 6.3. I believe this means the market is bearish with regard to this sector. The annual earnings growth expected is 25.6% according to analysts. This earnings growth is inconsistent with the current PE ratio. Markets are expecting revenue increases, but it won't be converted to profits. If they are to hit this target, there is much upside expected in OEC share price. I believe that they will be able to convert the revenue increases into profits. There are big risks that they face, like natural gas shortages in Europe, specifically Germany, and recession concerns. The management team is active in managing its risks. The next year won't be easy, but they have aggressive plans and have proven they can execute their ambitions. Comparing the OEC PE ratio to the average, we can see that they are overpriced versus its peers. The targets they have communicated to the market are ambitious but achievable for this business. I believe comparing them to their peers OEC is overpriced. Looking at the above analysis, we need to corroborate this valuation further. We will do this by comparing it to the industry and performing a discounted free cash flow model. Compared to the entire U.S. chemical products industry, I believe they are undervalued. There are very few companies with PE ratios over 30. Albemarle with 117 and Livent with 50 are the best examples of companies. The industry is heavily affected by recessions, which appear to be the biggest risk to this industry. There are trends like the shift towards EV that provides opportunities for the likes of Albemarle and Livent. Many companies in this industry like OEC are shifting their product mix to service the EV market. There are large profits to be made even though the industry might have a bumpy road over the next 12 months. I believe that there's an upside opportunity for OEC considering its value mindset and strategy towards growth. The PE ratio shows that there might be some opportunity on the upside over the next few years for OEC. This discounted cash flow valuation method looks at growth factors and discounts with a suitable discount rate. The calculations below outline how an intrinsic value for Orion engineered carbons is derived. By discounting future cash flows to their present value using the two-stage method. We use analysts' estimates of cash flows going forward 10 years for the first stage. The second stage assumes the company grows at a stable rate into perpetuity. All values are USD where a currency amount is calculated. OEC must stick to its strategy of investing in its capacity that is geared towards high-growth industries like the EV market. OEC also must start converting its revenue increases to profits and cash. If they realize these things, an $18 target is achievable. OEC faces quite a few headwinds. A significant one has been the high oil prices. This has affected their material prices significantly. Its teams have been able to pass most of these increases to its customers through aggressive negotiations. Recently, oil prices have also lost quite a bit of steam. So, we should be seeing margin expansion in the next earnings call. Geopolitical risks are occurring in Europe, which has resulted in a natural gas shortage. In Germany, it could cost them between $1 million to $5 million per month if the shortages had to get worse. They do have a deal in place with their natural gas provider that guarantees supply. This is because OEC produces electricity for the local communities from its plants. OEC is also working on reducing its reliance on natural gas where it is possible at specific plants. The strengthening of the dollar has also made a significant impact, as this could cost them $10 million per quarter in net sales. With the tightening of monetary policy in the US, this strengthening might continue. At least until global reserve banks can catch up to the US rate increases. The strong dollar issue might persist for the next 6 months, but other countries would take action to protect their currencies. OEC leadership has made some decisive calls in the last 3 years. They have proven they can execute key projects and decisions as well. In my opinion, the value mindset they are adopting will realize bottom-line benefits. They also positioning OEC for the future with its investment in an adjusted product mix and capacity. While analysts are concentrating on headwinds and talk about recessions. At the current price, I believe the bull case is clear.